Hello investors and welcome to my YouTube channel where I study the best investors and businesses from around the world. This week we'll learn the important lesson of patience. Over the years we've all heard about the great overnight investments that could have been, but how often does that actually happen? If it seems too good to be true, it usually is an old adage that has stood the test of time. When it comes to accumulating wealth, however, I'd like to suggest that time can be our most valuable asset. While opinions on Walmart stores range from positive to negative, one fact remains. If you had purchased the stock a few decades ago, you would have profited handsomely. Indeed, if you had invested $5,000 in Walmart stock, or WMT, at the start of 1976 and reinvested all of your dividends into more Walmart stock, you would now have over $5.4 million. Because the stock has split 8 times since 1976, your original 384 shares would now be worth over $120,000. Even if you had put $5,000 in 1981, you would now have more than $1 million. Now I know what you're thinking, that's fantastic, but how often does Walmart appear? And the best part is that it doesn't have to be a Walmart. The most important thing is to look for companies that have a track record of increasing both earnings and dividends. For example, Altera Group, the parent company of several major tobacco companies, Kraft, and a slew of other subsidiaries, could have made you a millionaire in 30 years if you had invested $5,000. Despite all of the negative allocations and lawsuits surrounding tobacco companies, this is the truth. Boeing Company, a major airplane manufacturer, is another stock that could have made you a millionaire. However, this is only the tip of the iceberg in terms of possibilities. Patience is the most important lesson here. The stock market has done exceptionally well over time, averaging over 10% annual returns. When you hear a horror story about somebody losing a lot of money in the stock market, it's almost always due to a short-term mindset. Allow time to work for you by investing in solid companies and holding on to them. Another thing to keep in mind is to diversify your holdings to increase your chances of success. They won't all be big winners, but if you can find one, it'll be well worth your time. In letters written by Nick Sleep and Kaya Zachariah for the Nomad Investment Partnership, they say, at the beginning of the AGM of Berkshire Hathaway Company, they show this little video, and each year Buffett is asked, what's the main difference between himself and the average investor? And he answers, patience. And there is so little of that these days. Has anyone heard of getting rich slowly? Good investing is a minority sport, which means that in order to earn returns better than everyone else, we need to be doing things different to the crowd. And one of the things the crowd is not is patient. Patience is the most difficult value investing principle to follow. When you have a high level of confidence in your decision model, there is a mindset that you want to see it succeed. The problem is that others in the market do not share value investors' perspective. There are so many different investing programs, methodologies, strategies, and even more buying and selling ideas, most of which are stemming from pure greed. The stock markets are overly volatile as a result of all of this. Value investors seek stocks with low volatility, such as large cap and Dow stocks. In order to earn good returns, volatility in mind, and small cap stocks shift the mindset from value investing to active trading. Value investors must be patient as these competing forces occasionally align to either depress or magnify the entire market, an industry, or a specific company. When the market causes a stock price to fall below a value investor's predetermined buy price, an opportunity exists and the value investor takes advantage of it. If irrational exuberance sets in, there will be opportunities to sell and profits to be made. Value investors must simply wait in the meantime. There are too many similes to list here for all of life's experiences. Patience in the stock market, for example, is comparable to deer hunting from a deer stand. You already know the prize will appear at some point. Years of experience and lessons learned have reinforced your natural patience. The same can be said for value investing. When exercising self-control, good risk management, intrinsic value buying, and financial analysis are and will always be rewarded. This lesson isn't about emphasizing patience, rather it's about recognizing how patience generates financial wealth in the market. Unlike day trading, which is essentially gambling, value investing is all about getting a good return on one's money. The key is to take a long-term view of value investing. Patience, a lifetime of patience, is what builds wealth. The key is to take a long-term view of value investing. Patience, a lifetime of patience, is what builds wealth. Waiting for better opportunities, it could be argued, is a more logical approach. Not only could an investor avoid losing money on today's overvalued stocks in the next bear market, but they might also be able to take advantage of the market cycle. For example, they may be able to buy the same companies that they are optimistic about now at a lower price in the future. Value investors have used this strategy successfully, including Manish Pabrai, the head of the Pabrai investment funds. Since 2000, he has consistently outperformed his benchmark. As Manish Pabrai said at a Google Talk in 2014, good traits or important traits for being a good investor. Number one, the single most important skill is patience. So I think the thing is that markets have a kind of way of deceiving us. Because, when you turn on CNBC and you see all of those flashing red and green lights and all that, it's inducing the brain to think that you need to act now and that you need to act immediately. Nothing could be further from the truth. Buffett always talks about having this punch card where in a lifetime you make 20 punches, and each time you buy a stock, you should punch it once, so in a lifetime you make 20 investment decisions. Which means that if you started investing at 20 and ended at 80, every 3 years on average you'd make one investment. And that is very hard for most people to do. And so the more you can slow down your investing and the more patient you can be. So the issue is that the time scales of which companies go through change and such is very different from the time scales of which the stock market operates. So you really have to focus not so much on the stock market and have a lot of focus on the nature of change in businesses and be willing to be in there for a while. One of the reasons why we like Manish Pabrai is that he is the perfect model of what ordinary people can do when they find something that they love and have a plan. Perseverance and discipline to do it. According to him, you don't make money when you buy a stock, and you don't make money by selling it. You make money by investing in undervalued stocks and then waiting for the stock's price to converge with its true intrinsic value. Pabrai is not alone in pursuing the strategy of extreme patience and extreme selectivity. Other famous value investors think the exact same way. Warren Buffett, for example, often compares investing to baseball, where you're given the luxury of waiting for the perfect pitch that you can then knock out of the ballpark. The stock market is a no-called strike game. You don't have to swing at everything. You can wait for your pitch. The problem when you're a money manager is that your fans keep yelling, "Swing, you bum!" What's nice about investing is that you don't have to swing at pitches. You can watch pitches come in 1 inch above or 1 inch below your navel, and you don't have to swing. No umpire is going to call you out. You can wait for the pitch you want, and the stock market is a device to transfer money from the impatient to the patient. Warren Buffett. Over the course of their careers, successful investors acquire a variety of valuable skills. You don't come into the world knowing how to research a stock or apply critical thinking to an investment opportunity. Those are skills that some people learn and develop over time. Patience is an important but underappreciated investment skill that I believe many people could improve upon. We aren't born with the ability to be patient. When we're young, we're more concerned with the immediate gratification. Ask any parent who has dealt with a child's temper tantrum. Patience, on the other hand, can be learned. And if you're an investor, learning it could help you achieve your financial objectives. Patience frequently entails remaining calm in situations where you don't have control. Even if we are patient in some areas of our lives, we must practice and adapt to new situations in order to be patient. Just because we're patient in line at the bank doesn't mean that you'll be patient when it comes to investing. Simply put, your brain makes patience difficult. Humans were created to respond to threats, whether real or imagined. People's psychological responses are triggered by stressful situations. You've probably heard the fight or flight response, in which you attack or flee, whichever helps you escape the threat. The problem is that your body can't tell the difference between a genuine physical danger, in which fighting or fleeing would be beneficial, and psychological triggers such as scary movies. It's difficult to be patient because it necessitates overcoming these natural instincts. Financial markets that are volatile can also trigger the response, but unlike scary movies, there may be real-world consequences that require patience to overcome. Your brain perceives a threat to your financial well-being when markets are seesawing and you're bombarded with negative financial media. As we saw this year during the lockdown-driven bear market, despite the fact that stock market volatility isn't a physical threat, the fight or flight response kicks in, emotion takes over, and your brain tells you to act. When it comes to investing, action frequently translates into selling something because selling makes you feel like you're protecting your portfolio from further harm. However, selling at the wrong time, such as during a major downturn, is one of the most common investment blunders. As Mahatma Gandhi would say, to lose patience is to lose the battle. Thank you so much for watching, and if you got any value from this video, smash the like button since that'll help this channel grow. Leave your comments in the section below and let me know your thoughts about this video and what I should cover next.